Good afternoon, everyone. Welcome to this week's Mashreq Sustainability Dialogues podcast, where we take a deeper dive into this massive push towards sustainability, trying to uncover intelligence and insights that will help our viewers and stakeholders navigate the journey ahead. The critical question that we're tackling today is pathways to COP28, how to expedite the adoption of green finance to support sustainability goals and inspire industry-wide transformation. We have our host joining us today, Thomas Jacob, who is the Senior Vice President and Head of Strategy at Mashreq, and our four special guest speakers, Aurelian Vincent, Partner at Strategy and Middle East, Bashar Al-Natour, Managing Director, Global Head of Islamic Finance at Fitch Ratings, Yusuf Makoun, Managing Partner at Cranmore Partners, and Anthony Berkeley, Director of ACT and Head of Investments at the FII Institute. Thank you all for joining the show. Thomas, I just wanted to first kick off with you as our host to get your overall comments on this critical question. Very significant. COP28 is on the horizon already. It seems like it's been building up for some time. But to get your insights on what the next steps are and what's the hope in terms of the tackling question that we're addressing today.
Great. Yeah. Thank you, Brian. Also, maybe also just as host, again, good afternoon, Aurelian, Bashar, Yusuf, Anthony, and Brian. On behalf of Mashreq, it is my great pleasure and privilege to invite you to this session as part of the Mashreq Sustainability Dialogues. And as you asked, in the backdrop of COP28, which is just around the corner, accelerating the adoption of green finance to support sustainability goals and inspire industry-wide transformation, I think, is critical. A clean energy, water management, climate change, life on Earth, life underwater, are some of the SDGs which need this green finance. And in the face of these pressing environmental challenges that we are seeing, such as climate change, resource depletion, I think it's the financial sector that wields considerable influence and resources to accelerate this transition to a sustainable low-carbon economy. And I think by prioritizing green finance, the industry can not only align with global sustainability targets, but I believe can also serve as a catalyst for broader transformation across various sectors. But I think, as you alluded to, this is not going to be easy sailing, as there are a host of challenges to be overcome in this journey. And I believe the discussion with this distinguished panel of experts will help us in navigating this journey better. With that, I hand it back to you, Brian.
Thank you, Thomas. We appreciate your insights and opening comments. Anthony, I just wanted to first kick off with you. Given your experience and, of course, at the Institute, it requires a lot of education in terms to accelerate adoption. Just wanted to get your overall opening comments on the critical question that we're tackling today.
Brian, thank you, and it's a pleasure to get these dialogues started. I want to salute Mashreq for being the host and sponsor and for their continued leadership in green finance in the region. So it's a pleasure to join you and this panel again for this discussion. It's obviously particularly timely now, as you said, in the wind up to COP28, which will be held in Dubai in the region, and will shine a spotlight, I think, not just on the global challenges in sustainability, but the emergence of the GCC region as a center of innovation and leadership in capital markets. I'm fortunate enough to be with the FII Institute, and we're the host of the largest global investor conference that's held annually outside of Europe or North America. It's called FII. Some of you may have participated or may be aware of it. Our annual summit in Riyadh was held at the end of October 24 to 26, and it unites the global capital market leaders, and that's not an exaggeration. All the top-tier media, all the CEOs and key executives at global corporates and investment banks and large asset owners all join us in Riyadh. So maybe I can share a couple of headlines I have from those discussions, what I was hearing in the plenary sessions and the panels and in the hallways as I address this question, and would love to hear what my podcast colleagues feel as well. So it was clear that in the immediate term that capital markets leaders were concerned with crises in the region, with unpredictability and with some macro factors like rates. But their long-term vision was also very consistent, which is they were optimistic in the long term, and they were just absolutely consensual about this transition to a more sustainable economy and the real opportunities, if you will, for value creation in that transition. There was no dissenting notes. Everyone sees it coming, and questions are about the when, the how, and the if. And the important role that the Institute plays is as a convener of those dialogues to hopefully accelerate that transition. I would say there's tremendous work to be done on the finance side itself. So on folks that, like myself, make the decisions around investing. We need to continue to integrate into our decision-making process the factors that allow us to both analyze the risks and also appreciate the opportunities. Sometimes that's called ESG integration. I think that's an area of continued advancement. And then on the asset side or the project side or the company side, one of the things that we've seen is that there was a perception in the market that the data wasn't available when you got out of some of these more advanced markets, say in Europe. And we're seeing that that's becoming less and less true. And so I would just point that out as a major trend here, is that the reporting, the adoption of the frameworks, the understanding of how to design and develop projects to meet global standards is now very widely distributed. And I think this region has some of the most exciting projects in this area. I'll just use two as an example, and then I'll pause as innovation and leadership. One is hydrogen. So hydrogen is looked to as a source of alternative energy of the future. And many of you are probably aware that one of the so-called mega projects in Saudi Arabia will be one of the world's largest producers of hydrogen that can be used in this alternative energy sense, and will be less carbon intensive in its manufacture than traditional methods. The largest project, and it's a real benchmark, if you will, about where we can take these solutions. Another solution has emerged recently in Saudi Arabia in the last 2 years, which is the support for voluntary carbon markets and the establishment of a regional voluntary carbon market, which is bringing together folks that are involved in, say, forestry or other projects that remove carbon with emitters who want to begin to address their carbon budget and voluntarily buy these carbon credits. I mean, it's tremendously successful. It's not just for the region. Actually, they've taken this globally, and they've worked as well in Africa. And I look for these types of solutions, both working on the emitter side and then also on the solution side to be a big trend here in the region. And I look to a near term where we're viewed as on par with or a center of excellence, as well as our European counterparts.
I just wanted to ask a follow-up question, as you're very much involved in bringing these stakeholders together. But of course, there's an aspect of communication and knowledge exchange around this topic in order to, as our topic today is expediting the adoption of green finance. We've met with Reham from the PIF, voluntary carbon markets. That was a big process. Hydrogen's been on the books for a while now and probably still needs to be accelerated to adoption. What are your recommendations at that foundation start in order to communicate the opportunities around green finance clearly, to set up those standards essentially, that are constantly changing in definitions around ESG? What is your recommendations on how best to do that will bring this ecosystem together faster and help expedite implementation?
It's a great question. This is obviously a complex issue. One of the areas that FI Institute has decided to take a thought leadership position on is on this question of providing for the investors, so the sources of finance, the data that they need to be really confident about the quality of the assets they're investing in, data that's pulled against the global standards and has the same kind of KPIs that you'd expect out of a leading project anywhere on the globe. So we've created a platform to actually address this. It's called Inclusive ESG. And in the use of the word inclusive, what we mean to signal is that this truly is a global market, and we do need to encourage additional capital flows, let's say, from developed markets into more emerging markets. And we really focus on the issue of listed corporates, and developed a framework and scoring methodology that allows these high-performing listed corporates here in the region, but in other emerging markets, who are already well on their sustainability journey, to be scored and analyzed in a way that is built for purpose for emerging markets, so that their good performance and their track record of success and their outcomes can be better appreciated by the global capital markets. And our goal will be to work on a barrier that we perceived, and then I'll pause and I'll hear other folks' sense of the barriers, which is really on the knowledge and familiarity from the investor base, which again is largely concentrated in Europe and North America, with getting more comfortable and more knowledgeable about markets like the GCC for sustainability themed investments.
Aurelian, I just want to bring you in as well to get your opening comments. You have a lot of experience in terms of managing risks, strategy, working with multiple corporates. Just want to get your thoughts on the critical question that we are tackling today.
Yep, sure. Thank you very much. Thank you, Thomas, as well for the invitation. It's a pleasure to be here. So I would say that the first point is that the problem we're trying to solve is big. There has been actually a very significant increase in climate finance amounts over the past few years, and now I think the latest is we're talking about amounts of around $800 billion that are injected. Depending on how you define it, it's not only climate finance or green finance, but this is the ballpark number we're talking about. And still, that amount, according to research that we've done recently at StrategyN, is still 6 to 10x lower from the required financing needs to reach the Paris Agreement goals. So the amount of the problem we're trying to solve globally is huge. I would say it's also particularly significant in our region, and one of the reason for this is that the supply of capital is actually unequally distributed on the globe. Actually, more than 3/4 of those amounts are injected into developed countries, whereas there is a higher need for infrastructure development, whether we're talking about transportation or energy systems in the developed markets. And the Middle East is no exception to this. So in fact, to the overarching questions on how to expedite the adoption of green finance, frankly speaking, for me, I would see it as a typical market, right? You have the supply of capital dimension and you have the demand of capital dimension. On the supply of capital dimension, I think that there is a clear effort, first of all, to increase the scale, as just mentioned. Then there is also an effort to make to create more space for the private sector to thrive, and this also includes being more innovative in terms of what are the instruments that we're using to make this happen. As of today, according to the climate policy initiatives, more than 50% of the green financing funding actually comes from the public sector still. So there is clearly room for improvement when it comes to the private sector. And another aspect on which I think that the GCC, and I'm hoping that this discussion will happen in the next few weeks at the COP28, needs to push on as well, is that the vast majority of the financing in sustainable and green finance are geared towards transportation and energy system. And there is still a lot to do, especially I'm thinking about brown transition finance. And there is an opportunity for the Middle East, considering the legacy we have here from hydrocarbons and oil dependency. There is a leadership to take into what is it that the Middle East, can do to advance that question and to also create impact in terms of carbon emission reduction in the brown finance. This agenda, to be honest, is not really taken by the Western world, and I believe there is a nice opportunity here. And the last point I want to make as well, because I mentioned the demand of capital, is the lack of credibility and the lack of standardization and the lack of maturity of a lot of those projects that are so-called green, sustainable. As Anthony mentioned, there is a clear need for standardization to avoid the elephant in the room, which is the greenwashing risk. That is a serious threat, I would say, to green finance in general. And there is a need to standardize this. If I take just project finance, there is, as we know, a lack of financing of project finance deals in the developing world. And the reason is mainly because this, not necessarily because of the intrinsic risks that are related to these projects, but because that standardization does not occur. And by the way, that does not only apply to the green project, it's also a wider issue that you have in project finance, but that is one of the roadblocks we have. So solving these two aspects of the equation will help us go into the right direction from my viewpoint.
I just wanted to follow up on that statistic in terms of public sector involvement and the private sector involvement in financing. What needs to be done in order to get more private sector involvement into this process? Typically, you have the public sector creates an ecosystem, and then it incentivizes the private sector to join in on that. What's the spark that needs to be done in order to accelerate and change those numbers that you mentioned? What are the challenges, and kind of what are the next steps in order to accelerate what we're trying to achieve with this critical question today?
There is obviously a dimension of, as I mentioned, of being more innovative in terms of instruments. For instance, most of the financing occurs from equity and debt, corporate debt financing, right? And also from capital market to a certain extent. But the carbon rights we, for instance, mentioned have not scaled up to, they are not really at scale as of today. For instance, sustainable derivatives are just emerging in the Western world. There's still a long way to go. There's a lot of examples of higher sophistication we can make. But to be very frank, the answer is very straightforward. You need to make it sustainable from a financial viewpoint as well. You will not be able to attract the private sector without making it profitable. And hence, there's two ways of making this. You can use the private sector to incentivize, to subsidize. That could take the form of tax cuts. We've seen with the Inflation Act in the US, there was a lot of this. And there is another dimension, which is the stick, right? So forcing mandatory reporting, blaming the bad players, and also forcing by mandating a certain number of targets in terms of whether it's carbon emission reduction or a certain shape that the balance sheet of banks should take, for instance, in at least X%, I won't give any number, of the balance sheet that needs to be geared towards renewable energy, just to make this up. This is the other solution that's on the table that the regulators have not taken yet, because obviously it is very constraining for private players. But if you want a quick solution, that's probably one of them to consider.
Yusuf, I just want to bring you in and get your opening comments on the critical question as well. And also touching on that point of, it is not just, people and planet, but also profit, and incorporating that into the aspect. There's short-term needs, but sustainability, ESG tends to be a longer term vision in terms of ROI. And your thoughts on how to navigate that entire process.
Sure, thank you. And also thank you, of course, to Thomas and Mashreq for inviting us. Very pleased to be on this panel. To narrow down the topic, and I think we've already honed in onto it, perhaps we are talking primarily about sustainability in terms of targeting net zero and decarbonization in the energy system overall, right? And we see several topics there. Primarily, firstly, we as practitioners, and I run an advisory boutique primarily focusing on project finance related, let's say, toolkit. We don't necessarily see yet, other than in very specific circumstances, a lack of funding for well-structured de-risked projects. So that's the first observation, but that will probably change with the pace needed to reach net zero. So what are the levers that could oil the wheels of that machinery? As we scale up, there will be potentially several bottlenecks. We're starting to observe some of that, not necessarily in the context of sustainability, but overall investment pace in Saudi. There needs to be human capital, as simple as, for instance, human capital as a bottleneck at the relevant institutions. Even that needs to be thought through. Obviously, the balance sheet of the relevant funders needs to facilitate increased pace of deployment and amounts into that sector, as highlighted by Aurélien now. That may be a series of prudential but regulatory support that facilitates investment of long-term capital, which doesn't naturally sit with banks, into those areas, whether it's debt or equity. More generally, though, of course, the profitability is quite an important topic. The returns are quite an important topic, and this is a tricky decision from the public stakeholders' perspective in a situation where public finances are constrained globally due to the hyperinflation and geostrategic geopolitical risks that have increased, the general slightly negative sentiment, and that translates a little bit, as we saw, into a bit of a withdrawal from GDP spend into decarbonization in simple terms. We've mentioned hydrogen, we've mentioned renewables, and we've mentioned some of the, well, we've seen some of those struggling to reach the level of profitability in the constraint of what the public sector is willing to spend or is willing to provide as support. And short-term subsidies are rarely the solution. They may help in the short run, but in the long run, the scale of the problem is such that really level playing fields globally to give the signals of investment in a homogeneous way would be really helpful. And we talked about standardization, for example, in relation to incentives to decarbonize. I mean, in the European Union, there is a broadly liquid and deep carbon market, non-voluntary carbon market. In the States, it's not yet there, but there are heavy subsidies in the short run, which are helpful. And in the rest of the world, well, it's a disparate range of potential measures. And in that context, private sector investors into decarbonization are struggling somewhat to decide how to play and scale up in that context, because scaling up cannot be easily sustained with subsidies, as I was mentioning. Carbon border adjustment mechanism is helpful within Europe, and it should propagate the application of a carbon price globally, but it's not quite there yet. So you do also need probably some de-risking capital coming from multilaterals or public sector institutions in the interim. So this is perhaps an indirect, but perhaps a more efficient subsidy to also accelerate the pace of banks deploying in the space or capital markets deploying in the space. So overall, in summary, we don't necessarily see a shortage of capital so far, at least for well-structured projects, but being able to attract that capital on a kind of project finance basis naturally takes time. Subsidies are probably not the long-term solution in all this, and a global harmonization on regulation for decarbonization would be extremely helpful, maybe too idealistic. I'd welcome thoughts.
Just to follow up
Brian,
on that. Sorry, go ahead.
Just jumping in that. No, look, just to kind of add to what Aurélien and Yusuf said, I totally agree, right? I think if you think of it as bankable projects and non-bankable projects, I think bankable projects is what we really need, because that makes it easy in one sense, because there is a lot of liquidity and capital out there. It's for these kind of non-bankable projects which are promising that needs this kind of extra layer around it, right? I mean, that is where we need to start getting creative, innovative, come up with all these solutions. You know, just wanted to add that here.
Yusuf, I also just wanted to ask a follow-up question as well. Standards metrics, is it actually possible to create a regionally accepted standardization and metrics around sustainable finance? It seems that these are always shifting, the definitions are always shifting. You know, transparency monitoring is a big part of this. Is that more of a pipe dream, or do you have any recommendations on how that can be achieved?
Rather than thinking about nomenclature around sustainable finance, I can think about schemes that could be applied to standardize bankability of projects and the support around them. For example, the IFC has done this in relation to solar transactions in Africa and now beyond, where they provide and they work with the national utility and national government to provide a bankable offtake scheme for renewables. They started doing it about 10 years ago. We were involved in one of the first ones that closed. At that point, the next cheapest electricity in Zambia, this was the first scaling solar deal in Zambia, was 11 cents per kilowatt hour. We came in with our client at 6 to 7 cents per kilowatt hour. So that was a step change. They tried then to implement that in several other jurisdictions, which were not easily bankable, but through their involvement became quite standardized, with some success and not yet quite the pace that they would have liked to. I think a standardization of de-risking decarbonization projects would be more useful. Now, in relation to green finance standardization and nomenclature, what is absolutely key in keeping an eye on is indeed avoidance of greenwashing, as was previously mentioned, and therefore monitoring, no double counting, those will be crucial. But again, looking at corporate financing called green, I'm not sure necessarily that that is really the inflection point that is needed. I mean, that's already more or less there, and the issues that surround it are well understood. So it's a matter of information and monitoring there.
Bashar, I want to bring you in, get your recommendations on how to tackle this critical question. Of course, you're also in the Islamic finance space, which has been booming, has been a big part of this transition in the Middle East. But to get your opening comments and the role that Islamic finance is playing in terms of expediting the role of green finance and accelerating sustainability.
Thank you very much, and thank you, Thomas and Mashreq, for having me. I think it's definitely, as a rating agency, is not going to come as a recommendation, but it's an actual diagnosis of what I see. And it's interesting to hear my fellow panelists looking at that, but let me maybe zoom in on the region and start with the question is it needed in this part of the world? And I would say we've done a study for more than 114 countries for physical exposure to extreme climate and drought. And the GCC countries, 5 of them are in the top 10 and all 6 in the top 20. So there is no doubt that it's actually there and it's there as a need. Now, looking at the question, the other side of the question is, okay, how is that going to be funded? How is it going to be financed? And how is it going to move ahead? I think we need to look at it in 2 dimensions. The first dimension, top up, and the second one, bottom up. Meaning, the top up, do we have political will and ability? These 2 are important. In these countries, I mean, I can expand the discussion on more than that, but I'm focusing on the GCC. Do we have the political will and ability to pursue this? And the answer is, in some cases, we have stronger political will. And I think if I look at the GCC countries, I would say Saudi Arabia and the UAE are leading in terms of political will. And also, being all exporters, they have also ability to some extent. But there is ambitious plans that needs funding. And when I look at funding as a rating agency, I will look at debt, I will look at bank financing, I will look at government funding for projects, and I will look at equity. So these are the 4 dimensions. Now, how Islamic finance spans in that, and I think if you're talking about Islamic finance as a basic rule, if you're looking at Saudi Arabia, 85% of financing in Saudi Arabia is in Islamic finance format. That's bank financing. If I'm looking at Kuwait, 50% of the banking sector is Islamic finance. Qatar and UAE, you're talking about 30% of the banking sector being Islamic finance. Bahrain, the domestic part of it is around 40%. Oman is a little less, around 15, 16, 17%. So it's an integral part of the DNA of the financing sector. So it's not something that you can say, okay, I don't want to deal with that. If you don't deal with it, you're really excluding a big part. That's one. If I look at the debt capital market, and here I think the story becomes a little bit more interesting, around 30% of funding in these countries is in sukuk format. If I look at the ESG related funding and how much of that of sukuk is actually around 50%. So the actual representation of sukuk in the sustainable debt market is around 50%, which is more than regular. So we see a preference of building these sustainable when it comes to debt instrument over Islamic finance. Now, why is that? I think there is another discussion for this. If you remember at the beginning, I said top down and bottom up. What I'm discussing now here is more, okay, the landscape, there is political will, they're trying to do things. But I think we're lacking awareness. So the bottom up, for equity to be raised, for having bankable project, I think there is both still a maturing or a developing story on the investor and the issuer side. It's on both sides. So if I look beyond governments and their strategies and milestones that they're putting, and if I look at the corporate sector, if I look at the banking sector, this is not something that's very high on the agenda of many banks. This is not something that's high on many corporates. I would say not very high. In some cases, it's non-existent. And here I am talking about two developed countries in this part of the world. So I'm talking about the GCC, you're talking about developed banking sector, developed that, and you don't have awareness enough. It's not embedded in the companies, stakeholders, whether owners, employees, investors, or what have you, to go after sustainability. That is not the case for Islamic finance. So if I'm talking about Islamic finance, you can see it's an integral part. So why? Okay, we've talked about Islamic finance, we've talked about sustainability. Is there a crisscross between the two? The answer is yes. To simplify sustainability and ESG, I would just simplify it with negative filtering and impact. On negative filtering, Islamic finance already satisfied a large portion of that. So if I am sitting in any presentation globally with an advisor or an investor or a banker, they will have a slide there with crosses saying no tobacco, no alcohol, no gambling, no pornography. I will just ask them, go back to that one. That's already embedded in Islamic finance. So you don't need to do really a lot for the negative filtering. The missing part is really the impact. And here you go back to do we have bankable projects? Do we have enough projects that you can put in the market to finance, let alone having the right bankable project? And the answer in many cases is no. It's still developing. We've seen, I would say, in the UAE, specifically in the last 12 months or so, a lot of initiatives to really pursue sustainability. And I think this is at the back of also COP28. And that is creating awareness. Now, I think the question that we need to say, okay, we're talking about financing, it means money. At the end of the day, how is that going to translate in the future to, are we going to see something that's more than government initiatives? We have few banks that are really pursuing ambitious agendas, others are not. Corporates, much less. Projects, much less. So at the end of the day, I'm looking at it in a simple term. Financing needs and investors. And on both sides, on the regional side of things, they are still both developing at an early stage. And I have to say, Islamic finance has been playing a role in financing in general and sustainability, as I demonstrated, it's actually playing a higher role. And why is that? So I expect this trend to continue. But the pace of that will vary significantly from one country in another, not only in the GCC, if I'm looking at the 57 countries of OIC where Islamic finance is active. But I can tell you that if you ask me how much of the rated universe you had 5 years back of Sukuk, which is Islamic bonds, I would say close to zero. Today, our rated universe is around $150 billion Sukuk outstanding as of Q3, and almost 13% of that is in ESG Sukuk format. So it has been growing in the past period significantly, and we expect that trend to continue. And that is definitely a source of funding that cannot be missed in a region where Islamic finance is a significant part of the DNA of financing.
Just want to ask a quick follow-up to that. Of course, you have top-down, bottom-up, you have political will, and everything's developing. Where does transparency play a role in this process? Obviously, Fitch ratings, it's a big part of that aspect. Where does transparency play a role, and how do you see that aspect progressing in the region, regardless of Islamic finance or traditional finance overall?
So Fitch is more than 100 years old institution. It is based on the confidence of the rating on the credit side of things, where it takes its strength, and it has been there for more than 100 years. So the actual acknowledgement of investors of saying Fitch is saying this is AAA or BB is a significant one. When I link that to ESG, there is two dimensions. We've added and introduced it in the past few years, something that's called ESG credit relevant scores to almost all of our issuers. So all of our issuers carry something that is called ESG credit rating score. That is looking at ESG factor between 14 to 15 factors, which is E, S, and G, and assessing all of the issuers in terms of these from a credit perspective. What does that mean? How is this impacting the credit of these issuers in terms of their rating? And it's directly embedded in their ratings. That is one side. The other side of that, Fitch has a sister company that has been established extremely recently called Sustainable Fitch. So it's a separate company that actually do a rating, a sustainability rating. So Fitch Ratings is a credit rating agency, and it has ESG credit relevance score. And there is a sister company that is providing sustainability. Now that when you're talking about a reference point and comparability and confidence, so these three, in my mind, is essential. So if you have something that you can compare between an issuer, and this is credit rating. So if you have a triple B in the Middle East and a triple B in Europe or a triple B in Asia, it's triple B. It means the same thing in terms of credit risk. That is a very important reference point. That helps in transparency. That does not mean that there is still greenwashing. There is a lot of issues on Islamic finance itself. Also, there is lack of confidence, lack of awareness, let alone ESG and sustainability. But at the end of the day, you have a reference point that is comparable globally on the credit side. And now we have a sister company that's doing it on the sustainability side of things too.
Anthony, I wanted to bring you in on that topic of transparency. Greenwashing, of course, is thrown around, but even the definition of greenwashing constantly changes as well. What is your recommendations from the conversations you had from your experience on how to tackle that in the sector, and essentially how to use transparency as a selling point, which we see in a lot of spaces now in this segment?
It's a well-framed question, and I think the right context is what Bashar was sharing with some helpful details, which is that the pace of innovation, the pace of change in finance, in Islamic finance, and in the region around sustainability has been breathtaking. And so the last 2 to 5 years have seen a complete transformation of the region in this area. It also means that with speed, there comes, anxiety and questions. And so we have to realize that in this next phase of growth, already from this very solid base that Bashar and others have painted, that questions of trust and transparency will be foremost on the minds of many investors, particularly those who we want to attract to the region, right? So we want to grow the pool of capital. We want to grow the number of bankable projects. So we're kind of growing beyond this solid base of early innovators that have gotten the markets going. And I think in this area, as you mentioned, committing to and then being thorough in reporting and disclosing against the highest level of global standard is critical. I don't think we're at the phase of this industry where you can kind of pick your acronym and your standard and your approach and argue for it. I think there's a very clear global movement towards standardization of the frameworks and the reporting standards around sustainability. It's being driven by the International Sustainable Standards Boards. They've released 2 reporting frameworks that are voluntary, but they've released in 2024. And now there's kind of a race going on to see the pace and the direction and the manner in which what's called IFRS 1 and IFRS 2 are going to be adopted globally by stock exchanges and other key market participants. So FI Institute, we're fortunate in the sense that we're in the room when a lot of these critical conversations are happening, and they're happening at scale with the largest asset owners and managers. And what we've decided to do is make a firm resolution or commitment ourselves as a nonprofit foundation and think tank. So at our last event at the end of October in Riyadh, one of our board members expressed this commitment to inclusive ESG. And for us, what we're going to do is we're going to design a coalition of like-minded companies, investors, regulators, and NGOs who've played a key role in this industry from day one, to join with us to sign on to a coalition that really has 3 main planks or 3 main areas of action. The first is to adopt these global leading standards. Don't wait, don't hesitate. Don't allow yourself to be confused. There's plenty of consulting resources if you need them. And if you're an investor, there's a set of standards you need to adopt for tracking and disclosing the impact of your investments. If you're a company, if you're managing a finance project, et cetera. And we just need to voluntarily take these steps and continue this incredible track record of leadership that Bashar has outlined for us. Secondly, we need the data then to make the hard work of reporting and the hard work of tracking meaningful to the markets. And so again, our tools focus on listed corporates, and it's called Inclusive ESG, and it's widely available through the ESG book platform. It picks up a corner of the market, right? It would help you if you're underwriting a bond that was listed by a corporate, issued by a corporate. You wanted to understand the sustainability performance of the issuer, or if you're making a listed equity investment into an emerging market corporate. There's other corners of the market that will need additional data solutions to really make them more transparent and easy to access by the investor community, and then more attractive for the issuer community. And then thirdly, we've called, and we think this is a pretty key one, is for, again, we're thinking globally of asset owners, for asset owners to increase their exposure in their sustainability portfolios to emerging markets, which would include the GCC prominently, to 30% of assets under management or owned assets. You might say, oh, 30%, is that a modest goal or an aggressive goal? It's actually quite aggressive. And the reason being is that globally, investments in sustainability in emerging markets have been only a small part of the global ESG flows. So global ESG flows now largely remain in Europe and North America, where the asset owners and managers are, and less than 10% flow outside of these developed markets into emerging markets. And this is true if you look at listed equities. It's true if you look at public finance. In the project finance world, I think the picture would have to be analyzed further, but I know the larger flows in the public world. So there's a huge gap and a huge opportunity. Our analysis painted a $5.4 trillion opportunity to bring emerging market sustainability assets in line with overall exposure to emerging markets in these large trillion-dollar portfolios. So we think it's a big opportunity. When those flows can be encouraged and they can begin to accelerate, then that will really provide a lot of liquidity and a lot of capital for the strongest, most bankable projects in our region, for the highest performing corporates on the stock markets, for the debt they issue, et cetera. And we think that would have an incredible impact on just driving sustainable development forward, GCC, but all throughout emerging markets.
Aurélien, we're talking about greenwashing, monitoring, transparency, that constant area that's always evolving and progressing, and of course companies, organizations, they're ranging from A to Z on their journey in terms of developing a strategy where they can be transparent, to convey data, to be able to report on ESG, for example. What is your recommendations and advice on how to start that strategy in the foundation, and kind of where you rate things today in terms of how that's been progressing?
Sure. So look, we've been advising a number of private sector financial institutions on their ESG strategy, and there are typically a certain number of steps to indeed follow. I just wanted to rebound on the previous question and Anthony's answer, which I fully second what was said, and I would perhaps just add one dimension that will reinforce the credibility, in particular in capital markets, of green bond or blue bond or sustainable bond issuers, which is having, and I think Bashar pointed to it, which is to have also a regular third-party review of the reports that are published by the respective players. This will only reinforce the credibility and the confidence from the end investors that their money is actually used to the right, the proceeds are used to actually invest and fund green projects or sustainable projects. Back to your question, look, the key part, and this will not come as a surprise, is to start understanding what's the starting points and collecting the data. It might sound as a bit of a cumbersome task, especially in the field of sustainability, but this is very important because in most institutions, especially for those that are doing this for the first time, this data either does not exist or is completely unstructured and have not been formalized within the organization. So it's really about understanding what is, for instance, the carbon footprint of the organization, what is the status in terms of social KPIs, for instance, but also because sustainability goes both ways, and especially relevant in the context of financial institutions, in particular of banks, what is the impact of the environment and society on the organization as well? Obviously, I'm talking about climate risk that could percolate into the balance sheet, but we can also think about reputational risk, for instance, as we all know now that no action is destroying value, not only sustainable value, but also business value, considering the importance that the sustainable consideration starts to have among, for instance, employees when it comes to talent retention, and among customers when it comes to negative screening, for instance. So starting with this and understanding the starting point, the second step is to define the vision, right? Without a clear objective, a target vision of what we want to achieve as an institution in terms of sustainability, nothing will be possible in terms of actual impact and action plan. And the push here is to go away from the washy-washy, statements that are so easy, to claim when it comes to being the most sustainable, etc., and to try and having some quantified KPIs. So the most well-known is obviously the reduction in carbon footprint and reaching net zero by a certain timeline. We know that the UAE, for instance, has committed to it as a country by 2050. And this is cascaded down into a certain number of institutions that more or less, comply with the same deadlines. But there could be other ways of doing this. And if I go a little bit away from green finance, that could also mean a certain objective of gender equality in the board or in the top management, etc. And there's a lot of objectives like this that need to be assigned. And then the first step would be, and one of the key things is to do it in coordination with the entire organization and in particular with the business, because one of the findings and what we believe in terms of what is a successful ESG strategy, it cannot be inconsistent with your business strategy, not in a private company. It is not possible. Otherwise, it will stay on the shelf and it will never be implemented. Hence, the need to co-create this portfolio of initiatives with both function and business owners. Prioritize them and then playing them back in an integrated roadmap with the leaders, seek the endorsement of the entire stakeholders, including the board and the shareholder, and then be extremely, I would say, accurate and disciplined when it comes to the reporting. As we just said, that this is one of the key elements to build credibility in sustainability. I would say those are the big steps that need to be achieved.
Yusuf, of course, those steps take time, creating a vision, strategy, but I believe you mentioned a critical part as well, which is the human capital aspect. And it's a conversation that we have with many stakeholders across the region. How do we ensure that we are meeting those human capital needs? And how does that human capital, financial literacy, incorporate into the third pillar, which we don't discuss enough, I don't think, which is society and having that education that could help accelerate these narratives towards expediting climate finance?
Tough question. And I have to say, I'm not a specialist of talent management and planning, but this is one area where... Yeah. But nonetheless, let me just anecdotally comment on it. This is an area where obviously, even at our humble scale, we started to feel the pressure, obviously the drive. And on the positive side, this also highlights actually ESG as risk management, by the way, and I want to come back to that. Aurélien has started highlighting it. The ability to continue attracting talent, but also to form talent in a way that keeps a pace with the evolution, which is on the plus side, irreversible today. And it's almost a one-way bet, although there are hiccups on the road. So this is one area where we do see in specific instances, governments as well as institutions playing a key role. I mean, I'm going to give an example that I've seen in Morocco, where OCP, who is one of the biggest enterprises there, big ammonia buyer, world's biggest ammonia buyer, potentially big player in the phosphate and fertilizer production, has taken on its own shoulders the initiative to invest in the energy transition formation, as it were, by creating almost a new university. In fact, a new institute in a university to support energy transition. Similarly, I mean, one can very clearly see relevance of skill set from the oil and gas sector to be redeployed. That is happening a bit more organically as far as we can see, but that's an area where maybe some of the former fossil fuel players that are in transition could also support. And of course, public authorities and stakeholders have a key role to play from a policy perspective in organizing that. We do a lot in the hydrogen space, and we did a fair bit in relation to, although that's not what we usually do, forecasting what the world would look like to the extent you realize green hydrogen taking on green oil, clean hydrogen taking on natural gas. Sure, in terms of bottlenecks, there are a few areas, I mean, leaving aside scaling up of normal industrial processes, etc. In some of the rare metals, in terms of some coating of specific kits and so on and so forth. But the second biggest area was very much in the human resource. So to the extent that we shift towards green molecules globally, this will be one of the major bottlenecks. And clearly, the private as well as the public sector need to be in coordination to address that. I'm going to give an example as well, anecdotal example that we have faced, and that really was a wake-up call for me. This was about 7 years ago when I had just started the company, and one of my best, brightest young performers in the team basically declined to work on a gas-fired power deal, saying, look, I'm not going to do it. I'm really sorry, I do apologize. And instead of being really disappointed and getting angry about it, it led me to think, because unless we basically take on the chin and address the issue as opposed to resisting it, which, as exactly per what Aurélien was saying, you'll be increasingly left standing and you increase risk over your future economic value as this movement is irreversible.
Bashar, I also just want to get your thoughts on that comment in terms of developing human capital. Islamic finance, of course, has its own segment. The financial sector overall has its own segment, but it's a critical aspect and a pillar to the stool that we're addressing today. What are your thoughts and recommendations on improving that segment of what we're tackling?
To be very honest, I think that is essential. Why? Because it is the stakeholders. So you are developing the stakeholders. And when you say stakeholders, you're talking about employees. And I think Yusuf gave an example. Anthony talked about investor. And here I'm not talking about the regional and local investors where it's still developing. The international investor is already demanding from the region to be ESG and sustainable. And that is something that many countries in the ESG is behind FDI. And that is something that's essential. So that is developing also the investors and issuers in this part of the world. Then awareness. The problem is in many, I mean, if I'm looking at the bigger 57 countries, if I look at Africa and some Asia, sustainability is very low on their agenda. Why? Not because they're not really exposed to extreme risk, but they don't have accessibility to a bank account, let alone telling someone, okay, I'll give you a bank account that is sustainable. He'll just appreciate a bank account. They don't have access in some countries to clean water. So the priority of sustainability varies significantly. Human capital is important, but at the end of the day, it needs also to match the actual needs of that countries. There are some countries that whatever you do, it's not going to move the needle for them if he cannot put his money in a bank and he's putting it under the mattress because there is no bank, the bankability is low. So let's put that in perspective. Having said that, having the right awareness, whether on Islamic finance or sustainability in that issue, that is important, but it's not only awareness. So once you build awareness on all stakeholders, employees, investors, issuers, government officials, and government agendas, you have to build something else, confidence. So you have the awareness, but you're not confident that what you're seeing is green or blue or Islamic. And that is a very important thing. To build that, you need to have track record. And track record will either build confidence or lack of it. When we talk about greenwashing, when we talk about lack of transparency, when we talk about lack of disclosure, these are essential things. The driver of these, either having strong investor, now what we're seeing more coming from the West, investing in the region, whether Islamic or not, saying, I want these criteria to be met, or I'm not going to put my money in your sukuk or bonds. So that's one. Or having government saying, these are the regulations and the requirements for these financial institutions, corporate institutions to finance. So the awareness is something that is driven mostly, to be very honest, top down. Bottom up, it will depend on the need. That's already evolved in Europe. That's already evolved in other developed countries. It's not yet evolved in even the oil-rich countries to an extent to have that a priority. But I think what happened in COP28, and I think this is what Thomas said, okay, we've been living through a year where you cannot have a day without that coming to your desk. That created awareness. Building on that after this, so is this going to disappear? Or we're going to see substantial steps, not only by the government, but by institutions and maybe by regulations, by stakeholders that will put this more on the agenda, which will transform the actual situation or not. That is a question and an area to watch, and it's a significant, I think, important part of the development story of that in the region.
I've gone over time. These go by pretty fast, but I just want to, of course, we're talking about pathways to COP28. I just want to go around the room one more time for closing comments for a quick 10-second soundbite on what your expectations are for the outcomes from COP28, of course, tackling the space. Anthony, I just want to start with you. What are your expectations for COP28 in this realm of climate finance in terms of the outcomes?
Well, it's a warming world. But let's also focus attention on where there's momentum, progress, and solutions, and let's really raise awareness of the GCC as a region for investment opportunities for sustainable finance, not just capital raising.
Aurelian, your final comments closing out the session.
Sure. So look, my expectation from this COP28 would be a bolder ambition, and with a particular color and focus on the emerging markets. I think it's a nice opportunity for the Middle East and the UAE in particular to take the lead there, because I think this has probably been deprioritized over the past few COPs. So this would be my expectations.
Yusuf, we welcome your final comments.
What would be great is tangible outcomes in relation to solutions for acceleration to net zero, be it across the multiple parameters we mentioned: finance, human capital, supply chain, etc.
And Bashar, your final closing comments on outcomes for COP28.
I think are we going to see a continuation of the momentum that we've seen talking about COP28 in UAE and in the region in general in the coming years, or it's just something that's now? And how is Islamic finance going to demonstrate itself as a significant part of the industry? And is it going to look at the commonalities between it and that industry and maybe build on it or not?
And Thomas Jacob, of course, our host, welcome you to give your final overall comments on the session to close us out.
Sure. Yeah. Maybe I'll start with COP28 and first global stock take. Let's see what the report card looks like, and let it be a clarion call for further action. And okay, so maybe I'll just go into my closing also. So look, as closing thoughts, going back to the topic, I think increasing the adoption of green finance can really support sustainability goals and can be a catalyst for industry-wide transformation. I think there are challenges to be overcome. We've discussed quite a few, lack of awareness, standardization, limited number of eligible projects, and the need for a supportive ecosystem. But I think with the right enablers, infrastructure, and policies in place, I think the region can become a leader in the adoption of green finance. I would really like to say sincere thanks to all our distinguished speakers for their participation and valuable insights. And of course, thank you, Brian, for moderating the session.
And I just want to close out our session. For all those who are listening and watching this podcast, please feel free to follow each of our featured guest speakers today on social media, the organizations, and the amazing progress that they're doing in their own spaces as well. And of course, Mashreq, where we will be publishing this podcast and the content harvested from it. But thank you very much, everyone, for joining the show, and we look forward to having you back on in future segments. Cheers, everyone. Thank you very much.